7:30 p.m. only on Bloomberg Quint.
We have with us Mr. Rajnish Kumar, the Chairman of State Bank of India now, after reporting the bank's fourth quarter results. Mr. Kumar, you, while addressing the press, had mentioned that from the 1st of April 2020, none of these legacy credit costs are going to hit the corporate lending book for SBI. Just trying to get a sense of, what do these legacy issues show as far as the credit monitoring and the assessment of loans that was concerned in the past, and how are you countering that in the future?
Any loan becoming NPA, there are always two reasons. One is the macroeconomic factors, and another is within the bank, microeconomic. When it is within the bank, there is a process. It is a pre-sanction process, it is an underwriting process, there is a post-sanction monitoring. Whatever is within the bank, that is something which we have to fix. How do you manage the macroeconomic risk, or what we call the portfolio risk? That is managed through the defining the risk parameters, industry exposure limits. So, best way to manage the risk is to diversify the risk. So bank holds a very diversified portfolio, and in the past 1 year, bank has revamped all its policies relating to almost every industry. There is a much more focus now on the cash flows and capturing those cash flows and control over those cash flows. All our policies have been realigned. What were the sectors which ran into trouble? If you look at it, power, steel, EPC companies. Right? EPC is where, because it is suppose a consortium arrangement, so no bank has a complete oversight of a project, what is happening. That we believe is not the right model. So what we are doing is that we are funding now only project specific. Even in HAM, the NHAI HAM projects, what SBI said that we will be the sole lender to a project. And we have done quite a few projects where we were given, we have funded a project to the extent of 800 crore, 1000 crore. But the bank is the sole lender, responsible for the monitoring. And this, I believe, is a safer system. Rather than being that 800 crore I divide between three banks, 200, 300 crore. And even if there is a small request from or any modification is to be done, and then there is a running around between three banks. Right. So that makes it a risky business.
So it's consortium banking, but then out of the...
No, it cannot be out of, because SBI can take care of 1,000 crore, 1,500 crore. But when it comes to, say, 25,000 crore project, so we can't fund it or tell no. But again there, what is being ensured, at least we are making it very clear, that minimum exposure has to be not less than 10%. Okay. There has to be sufficient stake. Otherwise, what we have found, and there are arguments from both sides, that in a 25,000 crore exposure, a bank with 100 crore exposure can cause lot of nuisance problem in resolution when it comes to resolution or any decision making. So at least if any exposure is within 8, 9, 10 banks, and if it is with a substantial chunk, then I think people behave more sensibly.
Fair enough. During your comments, you also mentioned that over the next 12 months, the bank is trying to look at monitoring and better underwriting some of these smaller loans, sub 10 lakh category loans. Firstly, are you noticing some kind of stress emanating from there? And secondly, when you say improved underwriting, what exactly do you mean?
No, now, most of the underwriting even now is manual. So I want to take that example of 10 lakh to 1 crore, PSB 59 minutes. So there, it is a technology based, everything algorithm based. The system uses GST return, the system uses ITR return, bank statement, credit bureau scores, and arrive at a number that how much credit facility can be sanctioned. So something similar where the loan which are small value but the number is large. So improving that quality, it can be done through risk modeling. And that is where superior risk models need to be built. And that is where bank is moving in that direction.
Okay. One last question on the write-off side of the story. Now, you mentioned 17,000 crore worth of write-offs. Most of these are technical write-offs and likely to be recovered in the future. But one point needs to be asked. What do these write-offs they kind of represent? Is it that banks are losing hope in terms of the recovery mechanisms that are available, or secondly, was there an issue with the way these loans were given to unsustainable companies at large?
It is only a accounting entry and a balance sheet management exercise. So, SR Steel, for example, now we have 100% provision. One way of accounting is that 11,000 crore, it is sitting on your asset side. And on liability side, provision is sitting 11,000 crore. Another way is that this 11,000 crore on the asset side, you make it zero, right? And that 11,000 moves below the line, what we call. But that does not mean that we will not follow up the case in the NCLT or NCLAT for this 11,000 crore. So the difference between the two situations is when you recover this amount, if you have not done the technical write-off, then what happens when the money is received, your loan outstanding becomes zero and your provisions, 11,000 crore, so your provision requirement comes down.
Sure.
If you have moved it to below the balance sheet, then that 11,000 crore, when you write off, it is taken out of your P&L and already taken out of P&L. When you recover, it comes back. So it is all just accounting. There is a lot of misconception about this word at write-off. We have to find a better word. So that write-off is actually, suppose out of 11,000 crore, I recover 9,000 crore and there is no hope for recovery of
the
remaining 2,000 crore. Then that is a write-off.
Sure.
So I think we will have to find a better word so that there is a very complete clarity that what is a write-off and what is the accounting entry or a technical write-off.
All right. Thank you so much, Mr. Kumar, for joining us on Bloomberg Quint.